Welcome to today's lecture on support and resistance, trend lines, and chart patterns. These three key concepts form the backbone of technical analysis, a crucial tool for traders and investors alike. First, let's understand the importance of this lecture. As you can see in the topics listed, we'll be covering support and resistance, trend lines, and chart patterns. These elements help traders interpret price movements and anticipate future trends with better precision. By the end of this lecture, you'll be able to identify key support and resistance levels, where price movements tend to stall or reverse. Draw trend lines that capture market direction. Recognize common chart patterns that signal potential trade opportunities. But remember, technical analysis isn't about predicting the future perfectly. It's about increasing the probability of success by identifying critical price zones and patterns. Let's dive into these concepts and see how they can help you improve your trading decisions. Let's now explore the concepts of support and resistance, which are fundamental to technical analysis and play a key role in understanding price action. Support refers to a price level where demand is strong enough to prevent the price from falling further. Think of it as a floor where buyers step in to drive the price back up. Traders typically look for price to bounce off support levels to enter buy positions. On the other hand, resistance acts as a ceiling, a price level where selling pressure is strong enough to prevent further upward movement. At this point, sellers often take control, making it an ideal spot for traders to enter short positions or lock in profits from their long trades. These levels are not just theoretical concepts. They are points where real market participants interact, making them critical for determining entry and exit points in trades. Now let's talk about how to identify support and resistance levels on a price chart. As shown here, support and resistance don't just appear randomly. They form based on key market behaviors. One of the simplest and most effective methods is to use historical price data. By analyzing past price movements, you can spot levels where the price reversed multiple times, creating zones of support or resistance. These levels are often revisited by the market, making them significant for future price action. Additionally, you can enhance your analysis using technical indicators like moving averages or pivot points. Moving averages act as dynamic support and resistance zones as they move with the price, while pivot points provide predetermined levels based on historical data. As you can see on the chart, resistance levels can turn into support after a breakout. This concept, known as role reversal, is critical in trading. For example, once the price breaks through resistance, traders may watch for that level to become a new support level during pullbacks. By combining these methods, you can more confidently identify zones where the market may react and plan your trades accordingly. Next, let's discuss trend lines, a simple but highly effective tool for understanding market direction over time. Trend lines help traders visually identify whether a market is trending upwards, downwards, or moving sideways. They act as dynamic support and resistance, guiding traders on when to enter or exit positions. An uptrend occurs when prices consistently make higher highs and higher lows. To draw a trend line in an uptrend, connect at least two significant low points, as shown on the chart. This line provides a potential level of support where traders may look to buy. On the flip side, a downtrend is characterized by lower highs and lower lows. In this case, connect at least two significant high points to form a resistance trend line. Traders often use this trend line to identify points where selling pressure may intensify. What's important here is that trend lines don't just show you the direction, they also help you spot potential reversals or breakouts when the price breaches the trend line. As we move further in this course, we'll see how combining trend lines with support, resistance, and chart patterns leads to powerful trading strategies. Let's now explore chart patterns, which are visual representations of price movements that help predict future market direction. Chart patterns are broadly categorized into reversal patterns and continuation patterns. On this slide, we'll focus on one of the most reliable reversal patterns, the head and shoulders pattern. The head and shoulders pattern typically indicates a bearish reversal, meaning a shift from an uptrend to a downtrend. Here's how it works. First, we have the left shoulder, a peak followed by a price dip. Next comes the head, which is a higher peak followed by another decline. Finally, the right shoulder forms, similar in height to the left shoulder, and is followed by a break below the neckline. The neckline is critical because once the price breaks below it, traders take this as a signal to enter short positions or exit their long trades. The distance from the head to the neckline can also help estimate the potential price drop after the breakout. This pattern is important because it reflects weakening buying pressure and the potential for sellers to take over the market. By identifying this early, traders can act decisively and minimize risks. In this slide, we're looking at a bullish head and shoulders pattern, which signals a potential reversal from a downtrend to an uptrend. The structure is similar to the bearish version we discussed earlier, but in this case, the pattern indicates a buying opportunity. Here's how it works. The formation starts with the left shoulder, which is a low followed by a price rally. The head forms when the price creates a lower low before rallying again. The right shoulder occurs when the price forms another low, similar to the left shoulder, followed by a strong upward move. The key level to watch is the neckline, as shown on the chart. Once the price breaks above the neckline, it signals a potential trend reversal and an entry point for traders looking to buy. The distance from the head to the neckline can also help predict the potential target for the upward move. This pattern reflects increasing buying pressure as the market shifts momentum. By combining it with support levels or trend lines, traders can strengthen their trade setups and manage risks effectively. Let's discuss another important reversal pattern, the double top. This pattern is common and signals a potential bearish reversal, where an uptrend may transition into a downtrend. Here's how it forms. The asset's price rises and forms a peak, then retraces slightly before rising again to create a second peak at a similar level. The key characteristic of this pattern is that the price fails to break higher on the second attempt, indicating weakening buying pressure and a buildup of selling pressure. Once the price breaks below the support level, often referred to as the neckline, it confirms the double top pattern and signals the start of a downtrend. Traders often measure the distance from the peaks to the neckline to estimate the potential price decline after the breakdown. This pattern is valuable because it highlights a shift in market sentiment from optimism to caution. When combined with volume analysis, trend lines, or other indicators, it becomes a powerful tool for identifying entry points for short positions or exit points for long trades. Let's now look at the double bottom pattern, a classic bullish reversal pattern that signals the potential for an uptrend after a downtrend. The pattern forms when the asset's price creates two troughs at a similar level, unable to break lower. This indicates that selling pressure is weakening and buying pressure is starting to build. The resistance level, marked by the price peaks between the two troughs, becomes a key zone. Once the price breaks above this resistance level, it confirms the double bottom pattern and indicates the start of a new uptrend. This pattern often reflects increased demand as market participants gain confidence. Traders typically use the distance between the troughs and the resistance line to estimate the potential price target after the breakout. This setup is important for spotting reversal points in downtrends and entering long positions early while managing risk with stop-loss levels below the troughs. When combined with volume increases on the breakout, it provides a strong confirmation of a sustained move upward. Now, let's talk about continuation patterns, which signal that the current trend, whether bullish or bearish, is likely to continue after a brief consolidation period. One of the most common continuation patterns is the triangle pattern. Triangles form when the price consolidates between converging trend lines. This happens as the market takes a breather, and then, once the consolidation is complete, the price typically breaks out in the direction of the prevailing trend. There are three main types of triangles: symmetrical triangle, ascending triangle, descending triangle. Recognizing and trading these triangles early can help you position yourself in the direction of the trend and catch major price movements after the breakout. Later, We'll see how volume confirmation can further strengthen your strategy when trading triangle breakouts. Let's now focus on the symmetrical triangle, one of the most common continuation patterns in technical analysis. A symmetrical triangle forms when the price creates a series of lower highs and higher lows, as shown on the slide. These converging trend lines indicate price consolidation, where neither buyers nor sellers are in full control of the market. As the price nears the apex of the triangle, the point where the two trend lines converge, a breakout typically occurs. The breakout can happen in either direction, but it often follows the direction of the preceding trend. For example, if the market was in an uptrend before the triangle formed, the breakout is likely to be to the upside, continuing the bullish trend. Conversely, if the market was in a downtrend, the breakout typically leads to a continuation of the bearish trend. Traders monitor the breakout level closely, using it as a signal to enter a trade in the direction of the breakout. Volume plays an important role here. Higher volume during the breakout is often seen as a sign of strong confirmation. Let's discuss the ascending triangle, a bullish continuation pattern that often signals upward trend continuation. An ascending triangle forms when an asset's price creates higher lows while meeting resistance at a horizontal level. The upward sloping trend line reflects increasing buying pressure as buyers consistently step in at higher prices. Meanwhile, the flat resistance line shows that sellers are defending that level. As the price approaches the apex of the triangle, buyers usually gain enough momentum to cause a breakout above the resistance level. This breakout typically indicates the continuation of the prior uptrend. Traders often use this pattern to enter long positions once the price breaks above resistance. Set stop-loss orders just below the last higher low to minimize risk. Use the height of the triangle to estimate the potential price target after the breakout. This pattern is particularly effective when confirmed with increased trading volume during the breakout, indicating strong buying interest and the likelihood of a sustained move upward. Let's now take a look at the descending triangle, a bearish continuation pattern that often signals a downward trend continuation. A descending triangle forms when the asset's price creates lower highs, showing that sellers are gradually gaining strength, while the support level at the bottom remains flat. This indicates that buyers are defending this level, but with less success over time as sellers push prices lower. The key signal comes when the price breaks below the support level, typically accompanied by high trading volume, confirming the pattern and indicating a strong continuation of the downtrend. Here's how traders typically approach it. They enter short positions after the breakout below the support. Stop-loss orders are commonly placed above the most recent lower high. The target price is often estimated by measuring the distance between the initial high point of the triangle and the support level. The descending triangle is important because it highlights building bearish pressure and the gradual weakening of buyers, making it a valuable tool for identifying opportunities to profit from market downturns. Let's now discuss how we apply the concepts of support, resistance, trend lines, and chart patterns in real trading situations. Technical analysts rely on these tools to identify entry and exit points, key moments to open or close positions based on market signals, determine stop-loss and take profit levels to effectively manage risk and secure profits, confirm market trends and potential reversals, ensuring that trades align with the prevailing market direction. Here are some common practical applications. Buying near support levels. When the price approaches a known support area, traders look for signals to buy. A stop loss is typically placed slightly below the support to limit losses in case of a breakdown. Selling near resistance levels. When the price nears a known resistance level, it's often a good time to sell or short the asset. A stop loss is placed just above the resistance level in case of a breakout. Entering positions during breakouts. Patterns like triangles or head and shoulders can indicate major price movements. Traders enter positions once the price breaks through key levels, with the breakout direction confirming the next move. By using these methods, you can improve trade timing and reduce risk, making your trading decisions more effective and disciplined. Combining these strategies with volume and fundamental analysis further strengthens your overall approach. To wrap up, here are the key takeaways from today's lecture. Support and resistance levels help identify where prices may reverse or stall. Trend lines give a clear visual of the market's direction and potential turning points. Chart patterns provide predictive insights into possible future price movements. By mastering these tools, you'll be better equipped to spot profitable trading opportunities, improve your trade timing, and reduce risks. Always combine these techniques with proper analysis for optimal results. In this lecture, we explored key technical analysis concepts, including support and resistance, trend lines, and chart patterns, to help identify profitable entry and exit points. However, remember that technical analysis should never be used in isolation. It must be backed by fundamental analysis, which assesses the asset's intrinsic value through economic and market factors. Technical analysis primarily confirms the direction set by fundamentals and fine-tunes entry or exit points. Combining both effectively allows traders to navigate short-term movements while staying aligned with the market's long-term direction. This holistic approach ensures informed trading decisions, minimizing risks, and maximizing profitability.